Joe Mullings from 160 Studios, and I've got a real treat for you today. We are going to be examining probably an under-examined subject, private equity, health tech, med tech, and everything that goes with it. So joining me today from Oppenheimer Healthcare Investment Banking, Marc Cabrera.
Good morning.
Good morning. And Scott Fraser from Fraser Healthcare. Scott, thanks.
Good morning. It's good to be here.
So I'm excited about this because we've got an investment banker out of Oppenheimer who knows PE as well as probably most in the healthcare industry. And Scott, career in medtech as an operator, investment banking. And I've got a little experience building companies and careers over 30 years and dealing with all these startups in both VC and PE. So the Venn diagram here is going to be fun today. So you want to open us up, Marc, and just for our audience, let's start at a baseline. What's the difference between VC and PE?
Great starting point. And I think these two terms are often very much used interchangeably. It's the concept of there's an investment firm and they're going to make an investment in a private company. But if you really think about it, and you've had this experience working with companies that start off with 1 or 2 employees and grow to hundreds, the company's needs for capital as they evolve change dramatically over the life cycle. And so the investment profile changes. And so really to put VC and PE in perspective, I think you also have to think about what's the first funding round for a company. An engineer who says, I'm going to design a better hip implant, or I'm going to design this, they're typically starting with friends and family or angel investors. They may get to a certain point where they've actually gotten FDA approval, they've gotten a code for reimbursement, they're generating revenue. At that point, they may start to talk to venture capital. And venture capital is really the first institutional investors. They're investing in the company, they're not buying ownership per se. They get ownership by virtue of buying into the company. Fast forward, that company now starts to grow over the 3, 5, 10 years. It gets to a certain scale. It starts to look like a more mature, profitable company. It's got predictable cash flow. That's where PE steps in. PE really buys ownership and just allows the original shareholders to transition to another ownership base. The far right of that would be the public markets, going public, whether it's a SPAC merger, IPO. It's a whole nother set of investors. And so PE and VC kind of sit as institutional investors in the middle of that range.
Does PE, and both of your thoughts on this, does PE have the tolerance to sit in the pocket while the FDA decides the future, the outcome of a device or a procedure?
Generally not. I think the box for PE is actually fairly well defined. It's what are the cash flow projections that I can underwrite. The time frame today is typically 3 to 5 years. They're almost always using some form of leverage in acquiring the business. And it's really a math equation. And the underwriting that's used to underwrite the cash flow portion of that is fairly strict. And so a typical PE fund may see 200, 300, 400 deals a year. They may be investing in 2, depending on the size, right, 2 to 4 to 10 platforms. So they're kicking out literally hundreds of deals that actually have cash flow, actually have revenue growth, but there's some reason that it doesn't sort of strike the strike zone or hit the strike zone. And it's really accumulating that very well-defined set of assets that fit those boxes and managing that portfolio. I think it's a very different business than VC.
Yeah, and if I was going to say to add on that, and coming from a med tech startup and that was VC funded, the VCs are investing in a business plan and more importantly in a management team that can take an idea and commercialize an idea and grow it. When you get to PE investments and working with different private equity firms, they are investing in a financial thesis that has proven cash flow. And if you think about being custodians of an institutional fund, those two different philosophies and theses are very different. You can have a great idea, and we're seeing it right now a little bit in the cardiology space, where it's almost a de novo company, but there's no cash flow yet because you don't have an ambulatory surgery center or you have cardiologists that are employed by a hospital. That is more of a VC type investment thesis than buying an established business that has an established EBITDA in it. So it's an important distinction, I think, that I find with a lot of my medtech and pharma clients. They interchange the term because we all live in a VC world, being big strategics and buying VC funded companies.
Give me an order of magnitude, both of you, if you have the data, that what kind of money went into PE last year, into health tech, the PE money that went into health tech, and VC? Is there equal? Is it a seesaw, or is one of them a little bit bigger than the other side?
That's a great question. I don't have the data. I can tell you over the last 5 years, $2 trillion went into PE.
$2 trillion in healthcare.
$2 trillion. No, in PE.
In PE.
In
Okay.
PE.
Yeah. Okay. $2 trillion in PE.
Into healthcare, and I'm going to refer to Bain puts out an annual report in healthcare investments. And last year, healthcare investments by private equity was $151 billion into the entire healthcare sector. And then it's sorted through there. But what I think more importantly is you look at other sectors of the economy and how much healthcare investments outpaced other sectors of the economy, and why PE is so bullish on healthcare. Obviously, living through a pandemic and realizing the inefficiencies in a lot of healthcare delivery sparked a lot of that. And if you think about different healthcare providers, there was a need to hedge, meaning, you're a successful physician practice, you've been independent for years, you own a few ambulatory centers, and all of a sudden, the spigot was turned off with the elective surgery shutdown. That makes you feel very vulnerable with a very profitable business, and bringing in a PE partner is a way to hedge, your overall net worth and portfolio.
And PE probably was excited about that. So has the PE appetite grown in health tech, healthcare in the last 5 years, and independent of the pandemic?
Yes, the short answer is yes. So to put it in perspective, I think in 21 there was about $34 billion invested in medtech by VC. So to compare it to your PE number invested in healthcare. Right. So it's a smaller segment. Devices, in vitro diagnostics, probably the two leading categories. But here's the reality. You got to understand the business model of PE and even VC. The business model is raising successive funds. That's the business model. It's not really, can we find the next miracle cure, miracle device, or miracle system? It is an asset management business. And so when you think about PE, to your point, it is a financial thesis. They need to essentially deploy enough capital to represent 80 to 90% of that vintage fund and then harvest it. And it's really a very risk-averse model. I think the VC model is a little different. There's a much wider aperture in terms of taking risk. But the way that risk is managed is many more bets, smaller in size, broader portfolio. And so it just provides some context that, how many good ideas actually get funded. My guess is the majority of them actually don't.
Has the changing centers of care affected PE's aperture and appetite for investments over the last couple of years?
I think it has, and the way I think about it, and you've been doing this, we've all been doing this a very long time. It's where's the opportunity over the next 5 years? And so there's no doubt that digital health has really sort of turn legacy healthcare on its head in a lot of areas. A lot of it is, I think of it as micro-experimentation, that most of those experiments will fail. But think about, the impact of COVID, the economy, things like that. The big themes that we focus on today, pay for value rather than fee for service. patient experience, patient engagement. A lot of healthcare really is about, at this point, changing provider behavior and patient behavior.
Yeah.
I might even argue there's maybe too much tech out there.
And I look at it, and I think for big med tech, the big strategics, this market force of the trillions in dry powder that exist in PE funds, coupled with the top of the food chain in the healthcare ecosystem being the payers and CMS being at the very top, they have set a clear direction for site of service shifts. With whether it's total joints, cardiocath, or less invasive type procedures, to move the site of service out of the hospital setting into a network of ambulatory surgery centers that have always existed, but there's even more of a need now in a pandemic world. You have physicians that don't want to be in the hospital, you have patients that don't want to be in a hospital, and now you have payers that are incentivizing that site of service shift with both professional fees as well as facility fees. So it's kind of the perfect convergence of this market conditions and market forces that I would argue big med tech has never seen this force before. And I had a funny interaction, probably almost a year ago now, with a Fortune 500 executive from big med tech client. Said, well, I don't agree with this, and my KOLs don't agree with it, because the KOLs that we've all historically leaned towards and who have been society leaders have been academics. So you think about the threat to a traditional ivory tower, institution of having an ambulatory center that's owned and operated by physician owners as well as a PE sponsor. It disrupts that ecosystem in that local market. But at the end of the day, and I think all of us, we're all about the same vintage here, as you start to have elective procedures, the difference between having a procedure in an ambulatory center and a hospital is night and day. And it's so obvious for all of us as patients of that patient experience. And Marc, your point is what can you do to bring that patient experience almost more like a hospitality mindset versus an institution mindset of being sick.
Yeah, and so what I'm seeing is the consumerization of healthcare and health tech. It's the opportunity right now. So I just went through one about 8 months ago. I had an ICD explanted, right? Done in a remote care facility.
Yep.
And it was an unbelievable experience, right? Just went through some diagnostics, right, on a regular basis. Stress tests, right? 24-hour Holter monitor. It's not a concierge, it's the new center of care.
Yeah.
Tremendous difference involved. So I've got a question for you, because you've walked the hallways, the career hallways of med tech company, VC, startup, now PE. It's interesting that the CEO didn't get it, and he or she is very sort of reflective of what our current C-suite is, their experience, because they tend to be lemmings and play from the same playbook, right? If the changing centers of care are shifting dramatically, that then means the sales pipeline is changing dramatically. That then means that the sales forces in these med tech companies are potentially not well equipped in order to distribute the current and future technologies. What is that going to mean to health tech, med tech, the big strategics downrange? Are they prepared to deal with the Harvard MBAs and the Penn MBAs, whose job is to force rank our expenses and then start to sort of mitigate those expenses?
This is blindsiding not only big med tech, but pharma as well. And it's the rapid consolidation first that if you think about a big med tech company, your CRM, whether it's Salesforce or something else, is the engine that provides you the data. And if that data is incorrect, meaning that here we're in the Delray area, there may be 20 different ambulatory centers that are doing some type of orthopedic work. You have a consolidator come into this market and buy up those physician practices, and now those 20 ambulatory centers all fall under a PPM or MSO. which are new terms for medtech. And this is the vehicle that private equity is investing in. It is, if you think about it, it is the back office of a medical practice. It's finance, accounting, revenue cycle management, purchasing, HR, what have you, marketing. And it's a different legal entity than that medical group or than that ambulatory center. But it sits above those entities and manages those entities and delivers services to those entities. And what has changed is the centralization of purchasing or financial decisions around capital equipment. And it's frustrating to big medtech because the first thing that they look at, and Joe, you hit on it, is there is a set PE playbook. That once you go in, you implement systems, you have a team in place, it's usually year 2 or 3 that you start to look at renegotiating contracts. Labor, obviously, is your first, and HR expenses are where you see a lot of efficiencies in MSOs.
It's your biggest operating expense for most provider groups.
Right. When you get down lower, you tend to hit capital equipment expenditures or repairs of capital equipment, in the scope side of things.
Service agreements.
Service agreements. Further down that food chain is disposables. And when you have renegotiated contracts, what happens is they do the analysis, and Joe, you touched on this, this is not Betty or Sue who grew up in a hospital purchasing department. This may be Sue or Betty that came out of Wharton, worked in investment banking, and can run numbers around any medtech company contracting team. So they're looking for discrepancies in pricing and may do an RFP process to bring in new manufacturers in that process. If they see that a big strategic manufacturer maybe has 20 different price points in a network of ambulatory centers, that's frustrating to them. And they are looking not only to get the lowest ASP on a product, but more importantly, put it open for open bid, because ultimately what they're looking at, and their physician owners are now concerned, is the distributions from their ambulatory centers or the distributions from a practice. And PE is arming the physician owners now to think like business owners. And as simple as it sounds, all of our medtech clients operate under KPIs. And whether it's average daily demand or you look at how many selling days, the KPIs that are now being implemented in these private equity owned entities are almost identical to what you see in business, but yet medtech can't respond with how they're selling to, how's that going to influence your KPI?
And I'm going to complicate it even further.
Excellent.
Think about that same practice that for decades has been fee-for-service reimbursed. And now there's enough critical mass because of the PE consolidation that they get a contract with an Aetna or United, and all of a sudden 20% of their revenue is capitated. So it's completely different revenue model. But in exchange for that capitation contract, right, there's certain requirements around data, outcomes, reporting, things like that. Does the tech even support that? It's not, so it's part of it is cost, part of it is what does the tech do for me? Can it report outcomes? Can it track this? So it is a very multi-layered analysis, and I think if you don't understand what's happening really at the insurance level first and foremost, and how reimbursement's changing so dramatically, I think, you're going to get blindsided a couple times.
There are some really progressive ASCs out there. We have a good friend, Stefan Kreutzer, down in Houston, and he runs about a 40,000 square foot ortho called Innovate. And I won't say what the number is, but last year he got a substantial check for shared interest, aligned interest in outcomes and economics from a provider that said, you saved us this much, we're going to do a rev share on this.
Yep.
And Stefan is all about data, all about tracking, all about outcomes, not pay for services. And so is that the way that we're going to see healthcare finally going? I mean, we got hints of it with Obamacare, and we would hope that 9, 10, 12 years later, we were a little further along. But is this now forcing that hand on getting a little bit more towards pay for outcomes and rewarding that or shared benefits?
I think it is a It's a massive hand. It's largely invisible because most providers, think about the provider universe today, there's 1 million practicing physicians. Most of them still do practice in relatively small practices. They don't have the sophisticated information systems. But I'll use an example. I've been doing some work with a group in the Southwest, 70 providers, roughly $70 million of revenue, break even effectively as a practice. They made $1.5 million of similar shared surplus. They can't reconcile it to anything, but their big health plan said, this is how much we're going to attribute to you. And by the way, they probably generated more than that. But the point is, that is what's happening in the world today. It is 100% moving. And it's just really a question of what is your specific micro market doing. So we're all in South Florida. This is the epicenter of very advanced, very mature risk-taking models. If you're in certain markets where there's one dominant health system, maybe a couple of dominant specialty groups, you're probably still, those payers are still beholden to the fee-for-service machine.
And you also see, one of the things that I'm fascinated by is historically in the de novo development of an ambulatory center, it's anywhere from 18 to 28 months, depending on your building cycle and the different regulatory pathways you have to go through. Once you get through the final regulatory pathway and get your certificate of need, that's when you're contracting with CMS and other major payers. I think one thing that's changed that I've been following very closely is in the cardiology space. Right now you have de novo ambulatory centers that haven't even broke ground, that have payers proactively reaching out to the entity to establish a contract with them, which tells you what payers are looking at. And you talk to an executive with a Blue Cross Blue Shield, is their number one initiatives each year are site of service shifts. Is what can we do for our patient population that will remove a certain cost out of this patient population. And ambulatory centers, on a very rough, number estimate is you can have the same procedure with the same implant, same doctor, same anesthesia, same scanner at about 1/3 of the cost of what the hospital cost would be. And in some extreme cases, it's 1/4 of the cost. And it varies by subspecialty, but in big spend items like total joints and cardio cath, it is incredible savings with that same doctor and the same equipment.
You talk about the markets, and I'm curious on that. You mentioned ortho, we mentioned cardio and cath labs. Do you see leaders in regards to subspecialties that are paving the way and setting the model? In other words, ortho, cardio, GI, aesthetics. What are you seeing?
I'm seeing it. I think it depends on the specialty because, CMS can only handle so many initiatives in a year. But one of the big initiatives right now is in nephrology, right? The dialysis center is a very expensive treatment setting. It's been around for decades. The big CMS initiative is home dialysis. So there's a tech play there, but there's also a provider play. And so we're starting to see PE aggregate nephrologists, I would say reassert them as the primary decision makers around site of service. It's an incredibly fascinating thing to watch because they are reducing the spend on a very expensive disease category. I think you're going to see it in neurology, you're seeing it in cardiology. So, there's, in all of these, I think there's a very significant tech play. And it's the tech catalyst to move those procedures, the diagnostics, into a lower cost setting. And so you said same doctor, right?
Yeah.
It's probably better tech in this lower cost setting.
Yeah. So tech play, I want to jump on that because that's my sweet spot and that's some of our audience fixation. So when I think about tech play nephrology, I think about Outset Medical, I think about Quanta, I think about Next Stage from the at-home dialysis play. But then we're starting to see these open architecture site of care changes, and does telehealth get in there? So my nephrologist then can dial me up on my iPad and I've got a question. I've got a visit. And all of that can start to happen at home on the tech place. So maybe it's not just the at-home dialysis machine. What other components do you see fitting in there when we think about tech?
So it's going to be I think it's a basket, and I think your example is a great one. But it really is the convergence of a lot of different tech. So I'll use a really rudimentary example of you want to tech enable your home, right? So you go to Best Buy with a shopping basket, and you go, okay, I need a security system, I need my Alexis, or I need this. It's the same thing in migrating these procedures to either the home or an office-based lab or an ASC. It's the telehealth. It's some of the diagnostics that may be appropriate for that procedure. It's all those things really coming together and letting the provider say, okay, this is how we can do this. Number one, I think it's all about patient experience as well. So it may even start as early as, how am I registering for this procedure? Am I doing it online, or do I get the clipboard in the waiting room, right, where the line to put in my email is too short? It's silly things like that, but I think it has an incredible impact on patient experience.
That's a really interesting experience, and it's coming back to the bumpers. We talk about this, right? Healthcare is 18% of our GDP, and for so long we've been fixated on the acute procedure, when it seems like, I was at SDTS this last weekend in Houston, Eric Wilson's great meeting, and somebody put up a slide that said what's happening in medical device is the inverse of Moore's law. Every 2 years, it becomes twice as expensive to put a medical device into the marketplace.
And I think hitting on aligning your medical device or your technology with the KPIs of that owner. So in a lot of cases, it may be a more expensive technology, but if you have an economic story that you can activate a new patient population, you can treat a new patient population or chronic disease patient population more efficiently, keep them out of the ER. I mean, you see in healthcare IT, you see and with different apps, chronic disease management. And if one particular area is inflammatory bowel disease. These patients, when they end up in the ER for fluids, it can be $8,000 to $10,000 worth of costs. There's a lot of technology out there that effectively manages them and manages symptom scores with an algorithm that keeps them out of the ER, most importantly, and more importantly, keeps their condition under control. Aligning with KPIs is also important if you may have a new diagnostic technology. An area that I'm fascinated by, because it's going to be a wave that pharma is going to develop, is fatty liver disease, NASH. Huge patient population, literally and figuratively. You have a diagnostic technology or a few technologies out there that scan for fatty liver disease, essentially ultrasound wound. It reimburses very low. Physicians were reluctant to do this for a number of years. The more progressive practices now are realizing this activates a new patient population that will fall into a screening protocol, and it becomes a frequent flyer type model. So that's aligning a business model to activate a new patient population into a revenue stream for a practice or an ambulatory center.
So that's really interesting. You made a lot of good points there, but one is there might be technologies from the acute care side that might be, in fact, at that point of care more expensive, but in aggregate, over the cost to the healthcare system, may actually be less of a burden on the healthcare system.
Less of a burden, but for getting back to the owner, that private equity owner as well as that physician owner, you can put together financial pro formas that demonstrate that over the course of treating this patient population, it represents X versus not treating them. And you're bringing in a higher level of sophistication and business oversight and financial oversight to medical practices that have never had it before. That they're looking at the clinical outcomes historically, which is at most, critically important. But there's now a healthy balance between weighing your clinical outcomes with your financial outcomes.
Marc, do you find yourself in the PE world focusing on that chronic chronic disease state, right? So of the 18% of our GDP, 80% of that 18% is the management of chronic disease, hypertension, obesity, mental health, et cetera. Is that a target-rich environment for PE?
I think it is the target-rich environment. I mean, I've seen stats that the expenditure, let's say on the Medicare front, is actually higher than 80%. We're effectively a chronic disease country. And so when you think about that $4 trillion that is spent annually in healthcare, that's $4 trillion of revenue to the system. It's one of the largest industries in this country. 8 of the 20 largest companies in this country are healthcare companies, insurers and PBMs. The bread and butter revenue is driven by chronic disease conditions. So whether it's a 4 to 6 times a year visit to your primary care doctor, visit to the dialysis center, whatever it may be, that is the bread and butter revenue source for most of the provider system.
Well, gents, this has been incredibly enlightening. I know our audience is going to love this content, and we've got a bunch to talk about. Anything before we close out this session that we didn't touch on that maybe we should have?
I really liked your point, Scott. I mean, I think the idea of tech really thinking about it as a cost part of the equation, I think the perspective's got to be much wider today. So think about when you talk about medtech, what specifically? We're talking about AI-assisted data analytics? You're talking about an actual interface between a device and tissue? You know, what is the tech component? Because I think you're seeing such dramatic improvements in the ability to get data, parse the data, have payers with huge analytics departments really assess the data and make spending decisions. And it's not always going to be about cost. I think it really is going to be this matrix of quality, outcomes, cost, things like that.
On that point, here's my concern. After watching the behaviors of the medtech, health tech, healthcare industries over the last 30 years, we're trying to take a high-tech solution and put it into a Flintstones car. And there are stakeholders there that have every reason to defend their current business model. And sometimes we have to wait an entire generation for new technologies to get incorporated into a model that needs to be transformed. Is that where we are right now?
You know, over the past 30 months now or so, we have seen such disruption. And in some ways, the pandemic has opened up the floodgates with changes in healthcare and healthcare delivery. And I think there's much more of a willingness at the top of the food chain, the payers, but also physicians to embrace new models and new technology because they were disrupted. You know, I look at it in sort of in closing for your stakeholders and your viewers is what does this mean to me? From a strategy standpoint, it is a different playbook. It's not only following the money, meaning where is investment going and where are ambulatory surgery centers being built and where, you know, what's being funded, what of my customer base is being funded. It's then understanding with your product development team and your engineers, what can we do that will enable this thesis and, you know, with care delivery. And if you are, you know, if you're developing, you know, the next generation pacemaker and it's, you know, 50% more than, you know, the regular implant right now, if you don't have the reimbursement or the economic story to follow that, that's probably the wrong R&D spend that you should be looking at. So I look at where it's being disruptive, and I you know, draw on the experience of a lot of leading medtech clients. Is they are trying to figure this out, but more importantly, they are trying to align with where the KPIs are of these newly funded entities.
Yeah, I think, to answer your question, I think we've been there for a while. I think COVID has been a catalyst to, let's say, widen the whiteboard space that payers and other decision makers around reimbursement are really thinking about. Can we fund, can we really fund telehealth? Can we really do this? I don't know if technology is always the solution. I think you've got to start with the question, do we need another pacemaker? Do we need another spinal implant, right? There are things that are being done at the primary care side of service that are just good old-fashioned weight loss, right? Drop, your BMI below 20, and guess what's going to happen to your blood pressure?
Yeah, but we're a society that doesn't want to take a vitamin. We'll take an aspirin in a second to get rid of a headache, but we won't take a vitamin to keep us healthier before.
We may not, but it is happening. And so, interestingly, you think about like the fitness world, right? An Alive Core, right? There's a medical application for some of this, but it's a combination. And so I think you've really got to examine the ultimate end use and sort of a solution-driven idea behind tech. And so for a lot of your audience where they may already have a huge portfolio of investments, the question's got to be, how do you rationalize that portfolio today, given where the industry is likely to be in 10 years? Because it is going to be a combination of things like payers going, all of a sudden, oh, now we've got to figure out what are social determinants of health. That's not tech, that's food, that's housing. It's very basic stuff. If it's weight loss, it might be intermittent fasting, right? That has a huge impact clinically on some of the major chronic diseases, right? Well, there's great apps for intermittent fasting, but is there other tech beyond that? If it's CGM, is it the data analytics behind it and connecting those analytics with your PCP, right? There's not really a traditional legacy tech play there. It's data analytics.
And it's interesting you say that as we close out. There's a CGM app out right now with the same technology that are being used. Triathletes are using it now to manage their glucose.
NutriSense?
Right? Yeah.
Yeah. Fantastic.
Yeah. And so using the same exact app, right, and sort of device. And now I'm like, okay, I'm a triathlete, and that may leak itself down like the NASA Tang consumer eventually down to the right point. So absolutely fascinating. Well, I enjoyed this. I know our audience is going to eat this up, and maybe we can do this again and go a little deeper in another subject for sure. So Marc, thank you so much.
We could probably do 24 hours.
Oh, I could do a Jerry Lewis. I could do a Jerry Lewis telethon.
This is such a meaty topic, and regardless of the subspecialty, you can go very deep into what this means, because there's not necessarily a set playbook right now for every subspecialty. And I mentioned cardiology and Marc is dealing with this with his clients. It's a different thesis, and it's a little bit more venture in nature of how you're going to do this, because you have about 80% of the cardiologists are employed by hospital systems.
Awesome. Well, gentlemen, thank you. Marc, Scott, thank you so much. I appreciate it. I'm Joe Mullings from 160 Studios. Be well.